let's talk about that. So sellers, this is the time for you to kind of tune in, really listen, because we are going to talk about something when I've talked about this on my channel as well. We've seen homes now sitting on the market for longer than they have than like 2 minutes. They're sitting on the market for like maybe 10 days, which in the grand scheme of things isn't that long. But the only thing that sellers feel like they have is they have just a price reduction. And so we've talked about this too. We've seen our price reductions spike, a lot of price reductions. But there's another tool. There's another tool that we can utilize that will help put more money in your pocket as a seller and give the buyer what they're looking for, which is a lower mortgage payment. And that's the rate buy down. And I talked about this on another video of mine, because this is what new construction is doing a lot. They're doing these rate buy downs, and how can they help their buyers get in without having to pay these exorbitant interest rates and keeping their payment low. But it's a 2-1 buy down. And I just want to pop this up so that, again, when we talk about this, and whenever I talk about this, I always say, talk to a lender, talk to a lender, talk to a lender, because they're the ones that are going to have the numbers and have all of your information so that they can give you accurate information about what your numbers look like. So Matt, you're here. Let's talk about this 2-1 buy down. It's a great.
Yeah, and I want to back up just for 1 second, because we're so spoiled in the last several years in our market. We forget that a balanced market, historically, a home could be on the market for 3 to 6 months. And we're not talking about luxury. And I know that you've done a lot of luxury in your career too, Shawn, where it was normal for a multi-million-dollar home. It was more like a 12-month expectation to sell a home, right? So we're in a normal market. Now, as we shift to a balanced market, what does that mean? It means things are coming back, like seller concessions, people accepting contingent offers, sellers fixing everything on the Benzer, which is the report to have all the items fixed in the home. So now, with rates being elevated and sellers willing to make concessions, 2-1 buy downs, which were a thing over a decade ago, are coming back. And here's what it really does. It helps you get way ahead for at least 24 months, okay?
As the buyer.
As the buyer, and it's a win-win for the seller, because they're probably giving away less than what they would do on a price reduction. And I know, Shawn, you chose this price for a specific reason.
So I was just going to say that. So we looked at this price point because this price point is about the 2,000 square feet to 2,200 square foot house here in the Valley. Now, the median home price right now in the Valley is about $460,000. But at this price point at $550,000, we're at about that 2,000 to 2,200 square foot home. So I wanted to kind of break that down and show you, if you did a 2-1 buy down, what does that mean? And 2, how much is it going to cost the seller? How much is it going to save the buyer? And then I'm gonna just jump because I get impatient. I just want to show you this. When we start talking about this, this is what the normal price reduction is for that house, which is $18,000. That's what that same home that we're talking about in that price range, in that square footage, their normal average their median price change right now is $18,000. So let's go back and just look at this. And now, Matt, break this down and explain how this works. And this is how much the seller is only going to spend, but so they're still going to make money.
That was a great chart you just showed us, because essentially what we're doing is we are netting the seller almost 50% of that. Right. Because if we're giving away $9,600 instead of $18,000, that's more money in our seller's pocket. Right. So this is just an example. I'm not obviously quoting an exact interest rate, current market. There's a lot of variables, et cetera. However, what I will say is, if you use this example, just so that you guys understand how it works and what a great option it could be. If the current market yielded a normal 5.75 interest rate on a 550 purchase, someone putting 20% down, all right? The normal principal and interest payment would be $2,567 a month. So just under $2,600 a month, plus, of course, taxes, insurance. And in this example, we put down 20%, but if you put down less, of course, you'll have mortgage insurance as well. So basically what the seller is doing is they are giving an amount to subsidize the buyer's payments for the first 24 months. Okay. All they're doing is basically subsidizing it by saying, hey, instead of paying 5.75, you're going to pay 2 percentage points less year one. So your rate would only be 3.75 instead of 5.75, which is going to save you about $530 a month for the first year. So now you look at it and you say, okay, well, now I've got a P&I of 2,000 plus throw in taxes and insurance. It's going to give you a pretty reasonable payment that we were accustomed to, right, for a couple years. And then in year two, it goes up 1 percentage point, and it's still going to be a better payment than the fully amortized, which is in month 25. Okay. So you might say, well, that's great, Matt, but what happens at month 25? Well, a couple things can happen. So the money, the 9,600 is going what's called a custodial account. So it's your money as the buyer. It's just sitting in there for you to use. Now, if you look at everything we've talked about on inflation and potential looming recession, the chances appear to be very, very good that in the near future, most likely inside 24 months, but let's conservatively call it 36, there should be a refinance opportunity. Okay. So it leads me to Jose teed it up perfectly for me. Is there a penalty? No, it's your money. Jose, let's pretend here for a second that if you were to purchase the home, the seller pays the buy down, and in 12 months from now, you get a call from your loan officer, Matt, that says, hey, guess what? Interest rates have dropped over a point. I could get you a permanent interest rate of 4.5%, for example. Only 12 months have passed by, and the seller had subsidized that 3,264, right? So here's what happens. When you go to refinance and we go to pay off that loan, we're going to reduce the payoff by the amount that was sitting in that custodial account of 3,264. It's your money. So here's what's great about this. So people are talking about permanent buy downs. Well, let's just say for the sake of argument that if you pay 2 percentage points in discount, maybe your rate is 5% or something in that ballpark. But if you plan to refinance out of it in a couple years anyways, it would have been cheaper, at least on a monthly basis, to have the 3.75 and then the 4.75 for year two. Now, are there any promises made on this that we know what rates are going to do? No, of course not. But what we can do is we can make a very educated guess. We can also go back to the 1970s and we can see, hey, when rates have increased this fast in this short a period of time, they've always returned to prior levels inside 2 years. We can also say that recessions have always teed up lower long-term rates. With that being said, if we're pretty darn close, there should be a solid refinance opportunity.
And for the sellers, just take a look at the difference. So the seller's contributing $9,624 here to buy down this rate so that then the buyer is getting these lower mortgage payments.
Correct. So
I went the wrong way. Or you can do a price reduction at $18,000 and hope that you get a sale at that point.
Right. So let's just say you have a tenant in place till February. You're only giving away 1.75 in this example. On a regular conventional loan, you can give up to 3%. So you could allocate that remaining 1.25 to pay their closing cost. You could use it for an additional buy down. There's a lot of ways where maybe you have a young first-time home buyer who's a tenant, if they can either use down payment assistance or scrape together their 3% down payment on a conventional or 3.5% FHA, then you can sell the home. And absolutely, Jose, this makes so much sense for both sides. Everybody's winning. Everybody's winning.
I'm so glad. Because this is one of those things. When I first got in the business back in 98, the first experience that I had with rate buy downs is when I was selling for DMB up in Flagstaff. And so we did a release of just custom home sites, right? It was not even, there were no homes on it. And the interest rates were 8%. And we got together with a lender and we did permanent rate buy downs on this. And they were bought down to about the 5%. And it worked so well. So that was my first experience with it way, way, way back when I first got in the business. And so when people start talking about these rate buy downs now, I'm like, yeah. I mean, it makes it really is a win-win for everybody because the seller's still making more money, netting more money, and the buyer's getting exactly what they want, which is a lower monthly payment.
Right. And again, we're looking at real estate as a long-term hold, a long-term investment that should protect us. We're paying principal on all these loans these days. So we know we're lowering our balance. And, historically, the government would like home prices to only go up a few percent a year. They don't want home prices going up 30% a year.
Like we have for the last 2.
Correct. So it's, people are just spoiled and they're disappointed if home prices went up 5% a year. That's really good because real estate, we're getting to leverage a much larger amount. You're putting down 5% on something that costs 400,000. Well, you're getting all the return on whatever the increase is over 400,000, regardless of the fact that you only put 5% in to begin with.
Right.
And it's the reason why how most Americans accumulate their wealth is through real estate.